Most people think credit is just about getting a loan. It's not. Your credit report is used to decide how expensive your life is going to be, and in some cases, whether you even get the opportunity. Now, it's not just lenders looking at it. Your credit can impact your job, your insurance rates, whether you get approved for a place to live, and even certain government decisions. Two people, same income, one difference being their credit, very different outcomes. Here are 5 reasons your credit matters. Lenders, employers, insurance companies, landlords, government. Because if you don't understand how this works, you're gonna pay more and have fewer options, and without even realizing why. All right, starting with the most obvious one, lenders. When you apply for a loan, car, credit card, mortgage, they're not guessing. They're pricing risk. Your credit report tells them, do you pay on time? Do you carry too much debt? Have you defaulted before? Based on that and other information from your application, they're going to decide, will they lend to you and what it's going to cost. Bad credit doesn't always mean no. A lot of times it means yes, but at a price. Let's take an example. Same car, same $30,000 loan, same 60 months. One person gets 6%, the other gets 22%. That's about $580 a month versus $829. Almost $250 difference for the same car. That's cash flow every month. Now guess what? That individual who got the 22% rate because of credit, they're really not going to like this next one because they may also get hit here also. Insurance companies. Now most people don't realize this. They may use a version of your credit called an insurance score. Not your exact score, but built from the same data. Why? Because they found a correlation between certain credit patterns and claims. So they price it. Two twins, same driving record, same car, same zip code, can still get different rates. So now, the individual may be getting a double whammy on their car payment and car insurance. Employers. Now you might say, what does my credit have to do with my job? It depends on the role. If that job involves money, company cards, customer financial data, or any level of authority, they're looking at risk. Not necessarily perfection with your credit, but patterns, repeated late payments, collections, financial instability. Now, that doesn't prove anything by itself, and they're not trying to prove guilt on you. They're deciding how much trust to give. And that decision can cost you an opportunity. At the end of the day, if a business gave you a job without checking your credit and money ended up missing, could the employer be in the hot seat for not checking credit? Probably so. Landlords. You're not the only applicant. Sometimes you're one of 50. When it gets competitive, it comes down to a short list. Credit, income, job stability. That's it. Because they're not just picking a tenant, they're managing risk. You don't get denied because you're the worst applicant. You get denied because someone else looks safer on paper. And your job is to make sure your credit is the best in the stack. Government, especially security clearance. They're not looking for perfect credit. They're looking for stability because financial pressure can create risk. Debt, missed payments, patterns of losing control. I had a client with a gambling problem, and at first it didn't seem like something serious, but then it started showing up in his finances. Missed payments, rising debt, credit started dropping, and it became a pattern. He ended up losing his clearance, and then he lost his job. Not because of one mistake, but because of what it turned into. Now, with government benefits, now this is a little different. Your credit score alone usually isn't going to stop you from qualifying, but the problems behind bad credit can still follow you. If you owe back taxes, defaulted federal student loans, or child support, the government can take a portion of certain payments. For example, Social Security benefits can be reduced for unpaid federal debts or child support. So you may qualify for the benefit, but not receive the full amount. This is why I focus on cash flow. Higher rates mean higher payments. Higher payments squeeze your cash flow. And when cash flow gets tight, everything else gets harder. Saving, investing, handling problems. That's where your financial house really starts breaking down. Good credit lowers your cost of money. Lower cost means more room each month. But here's the reality. Credit takes time to build. Consistency over time. But it doesn't take much time to damage. One missed payment, one collection, one bad stretch, and it can change it fast and drop it. Not forever, but long enough to hurt you when you need it. If you want to build your financial house the right way and protect your cash flow, subscribe. In the next video, I'm going to show you exactly what's inside your credit report and what actually moves the needle. So we'll see you in the next video.